Hello and welcome. We're seeing a very resilient market in trade today. We're seeing a 150 odd point bump up on the index, and it's sustaining. I mean, we saw a bit of a dip midway through the day, but we saw a decent rebound thereafter as well. And it's a very tight range in which the market has traded in at around 80 odd points. So even the dip hasn't been meaningful or significant. Broadly, when you're looking at the Nifty, IT is the one which is really standing out in terms of the sectors. That seems to reflect even on the Nifty 50 index. You'll see some good movers from within the IT pack. The likes of an Infi is one of the top 7 odd gainers on the Nifty index. Eternal, though, is the top gainer, 2.5% higher. Kotak Mahindra Bank up 2% as well. So you're seeing some decent moves there. Shriram Finance, Bajaj Finance, Bharti Airtel are just some of your other movers in trade this afternoon. Just about 10 losers on the Nifty, and 4:1 is the advanced decline. Hindalco, Apollo Hospitals, Tata Consumer are just some of the names which are lower in trade today. When you're looking at sectors, and most sectors trending in the green, in fact, all sectors except the Nifty India Defence Index, and it's realty which is leading the pack, 1.6% higher, IT up 1%, FMCG as well as consumption also up around 0.7%. The Nifty Bank is showing resilience, 0.5% odd higher on the Nifty Bank as well. Pharma, PSU banks, autos are underperforming a wee bit versus the Nifty, but nonetheless, they are also trending in the green. The defense index is the only one which is the laggard. I want to quickly mark out some stocks. Aster DM seeing a bit of a knock, second straight day of losses, 3% lower on Aster. But you look at some of the other names. Waterways Leisure is up 10%. Bihari Lal Engineers is up 4.5%. Shiprocket is up 4% as well. So you're seeing some very decent moves, especially on recent IPOs. When you're seeing names, Good Luck India is up around 7.5%. Kiri Industries, relatively smaller name, up 6.5%. Aditya Infotech is the other one, 5% higher. Kolte Patil, Tega, are just some of your names which are buzzing. EMS on the back of an order win is also up and away in trade. Within the Nifty 500 basket, of course, plenty of movers. Again, the breadth is very positive, while it's not reflecting in terms of the strength of the move on the index, but the breadth is sharply in the green, 2:1 on the advanced decline. Balrampur Chini is up and away, 14% higher. Netweb, MMTC, Z Entertainment, Cohance Life Sciences and MCX are all gaining 5% plus. Even a Misho is up 5% in trade. 150 odd losers, and nothing which is significant except some of the power financiers. PFC and REC are down 2.7% each. So you're seeing some pressure on both of those names. Aster DM is down around 2.7% as well. Chennai Petro is down 3.5 odd percent. Those are significant losers, but just very few, as you can see. Let me go across to Avi. He's here with some of the stocks you want to keep on your radar today.
So let's have a look at some of the stocks that are buzzing in trade, starting off from Zaggle Prepaid. That has given us second day of strong rally after Mr. Vijay Kedia entered the stock yesterday and bought around 20 lakh shares at 164.7 rupees per share of a total worth around 33 crore rupees. The stock was up 10% yesterday and is up around 6% today. It is also important to note that the stock had corrected by almost 20% after its Q1 FY27 earnings. So a strong recovery and bounce after that since the ace investor Mr. Vijay Kedia has entered the stock. Up next is All Cargo Terminals that has come out with its July business update, and the total volumes handled stand at 62.7 TEUs. It is up 8% on a YY basis and around 13% on a month-on-month basis. It includes container freight solutions and inland container depots. It is also important to note that ICD, which is the inland container depot, is being done with the JV along with Concor. Up next is Aditya Infotech, which has announced a fundraise of around 1500 crore rupees via issuance of securities, and also the fact that Motilal Oswal has initiated coverage on the stock with a 27% upside, and that is the reason the stock is up around 3 to 4% in trade as of today. Up next is Kolte Patil Developers, in which the company has announced a new leadership for the company with Mr. Rishikesh Parandekar as the CEO for the company to drive the next phase of growth. And it seems that the investors are rewarding this news, and the stock is up almost 4% in trade. So these were likely the buzzers for the day.
that's a list of all the stocks that are buzzing in trade. Avi, thanks so much for that. We also have Kunal who's joined us in the studio. Kunal, before we decode all of these stock-specific moves, talk to us about how you're looking at the index today. Because finally, after 7 days in the red, the index has turned green, and now we're comfortably above the 24,200 mark. Is this kind of move here to stay? Can tomorrow also look this good?
Yeah, one step at a time. I believe that at least it's a good step that the markets have reversed the course of price corrections from 7 consecutive days. Because even though the correction has been a little bit more muted on the indices, however, I think it was something which the short-term traders were getting a little bit concerned towards, because we were very, very close towards breaking the 24,000 mark. We've managed to avoid that, and we've managed to avoid that in style, because it's not just our markets, but it's across the globe, and various commodities, asset classes turning around and showing signs of big up move, which means potentially this move should last for the index over the near term, and we could probably expect that the markets can slowly and steadily nudge its way ahead. On the higher side, the breakout point what we are looking out for is 24,300 as the spot levels on the Nifty, because this has been the pivot support for the index earlier. We fell below these levels by 300 points, and now on the way up, this is the first resistance which the markets would probably want to encounter. So once we break past about 24,300 levels, then we can look at much more higher targets for the index in the near term.
Okay. Kunal, the index has moved exactly as you had predicted. We saw a bit of a dip towards 23,180. The dip wasn't as deep, right? It was a very shallow dip, and the rebound has been decent as well. I mean, it's 50 points, but nonetheless a rebound. Talk to us, I mean, if 24,200 were to sustain, what are the new levels that this opens us up to?
So the more important level is 24,300, but once that is sustained, Harsh, we could be looking at a retest of the previous highs. Not the all-time highs, of course, but the recent high, which is 24,800 for the Nifty. So which means that potentially another 70-80 point confirmation of the index, and then we could be looking at a further 500 to 600 point on the upside for the Nifty. So I think what we've done is we've done the step one. We've managed to avoid the correction. Now the step two is that once we see the index graduating towards a decent breakout about 24,300 levels, that will probably have a strong impact. And remember, I think we are heading to the expiry, the monthly expiry also next week. So it'll be always very positive for the markets to go into the expiry, to close a series and then start off a fresh series when the tailwind is quite positive for the index. So what matters over here is that the next 1 or 2 days, if the index sees any kind of a mild follow through, 100 points, 200 points on the index over the next couple of days, that will have a very strong positive effect on the Nifty as well as the overall market going to the September series.
Okay, and here's watching out for that. And Kunal, in a market like this where you are expecting even a little bit further run up from here, what would be some good stocks to be looking at or some sectors to be looking at this point?
So IT is something which I'll be bullish on, and I think I've been bullish on the mid-cap IT names, Coforge and Persistent. Coforge is something which I had given as a recommendation in the morning. I think now I would select Persistent as a trade at the current levels. The stock is nearing a breakout yet again above 5,600, 5,650. So would look at a buy with a target of 5,800 for Persistent at the current levels. Stop loss to be kept at 5,640. The second would be from the real estate pack. DLF is something which looks attractive at the current juncture. The stock is heading towards yet another breakout zone about the 670-75 mark. And I would sense that once the stock confirms a breakout above 700 levels, it could also come in closing distance to break off its long-term moving average, which I think could be a big turnaround factor for DLF in the near to medium term. So bullish on DLF, target 710, stop us to be kept at 665.
Okay, that's the tilt. We'll take a pause on the conversation, slip into a very short break, come back, speak more. We will have Rakshit Ranjan of Marcellus Investment Managers joining us shortly post the break. Stay with us, more to chat about. Welcome back, and we're joined by Rakshit Ranjan, who's from Marcellus Investment Managers, joining us live at this point of time. Rakshit, great having you. Let me first start off by understanding how's the tilt of the portfolio changing, if at all there is any churn. What is it that you're buying afresh post this earnings season?
Yeah, sure. Good afternoon. Thanks for having me here. So the tilt of the portfolio for us, it's tilting more towards internet companies which are using AI-based product value adds, tilting towards healthcare, hospitals, diagnostics, and even export pharma running on CDMO tailwinds. So those are two sectors I would say we've increased exposure to more recently.
So that's the tilt in favor of some sectors. Rakshit, hi, this is Nehi also joining in. Good afternoon. Talk to us about some sectors that you are adopting a more wait and watch approach towards, or somewhere where you are very cautious at this point.
Well, wait and watch, I would say there are a few names in capital goods. Valuations had run up a lot, but the tailwind from a macro perspective remains over the next 3 to 5 years. And the West Asia war has put a pause on some of those orders, or put a drag on the margins for the time being. So hoping to see some opportunities there in the next couple of quarters. This is particularly manufacturing exports in that sector, not so much domestic demand. So that's one. Another wait and watch is, I would say, even some of the private banks. We've been underweight for a long time and benefited from that so far. Valuations are becoming incrementally more and more attractive. Having said that, it's also quite interesting to see how the sort of pristine quality of the book and net interest margins progress in that sector. So those are some of the areas where I would say we are adopting a wait and watch over the next couple of quarters.
Rakshit, again, if I were to go back to that play on AI and the like, how are you looking at power and power ancillaries with that lens? Does the story change materially for them, and do valuations support buying into some of these counters?
So we've got one holdco of a power T&D play in our portfolio, which is there more because the asset itself is quite richly valued, but the holdco is on a discounted valuation. So it's a valuation related call on the holdco, and hence we are exposed to T&D particularly on the power side, where demand exists for the next 5 to 7 years. Order books are very long dated, as in the orders that you see today. There's a good predictability of revenues basis that for a few years, and capacities are yet to come up from all sorts of players who started the capex. So we're yet to see a sort of competitive intensity of any sorts or pricing pressures of any sorts. So that's the T&D space of power where I would say we are more excited about. Rest of the power space don't have any exposure.
Rakshit, how about IT? How are you looking at IT right now? We're hearing a lot of mixed opinions when it comes to IT. Some people believe that the worst is behind us in terms of AI, and because of the kind of cut IT has seen, there's only one way up, while others are still concerned about the adoption of AI and the impact it could have. Where do you lie on that spectrum?
We are in the latter camp.
Okay.
As in we're still concerned. Maybe it's just us. Maybe we don't understand how it will evolve. But at the moment, we see a lot of uncertainty in terms of how the deflation of pricing and the substitution effects will play out for IT services. It's quite interesting to see how in the last 5-6 months the sort of emergence of internet players, which are beneficiaries of AI, of the same disruption that IT services are at a disadvantage of, have started to come up. Where initially in internet, I mean, this links to our increasing internet exposure as well. 6 months ago, there was a concern that will the LLMs sort of backward integrate everywhere and they'll disrupt internet, as just like IT services is undergoing a slightly different type of disruption. I think so. We are trying to play the AI theme from the internet piece, where products are coming out by good quality management teams who understand this space And those products are coming out in a way where AI is helping solve problems at scale which previously couldn't be solved without AI, and new use cases are coming out as a result. So that's where we are exposed. But on IT services, we've got zero exposure, and we think the uncertainty might prevail for a few more months, if not longer, before we can make up our minds.
Interesting. Okay. Rakshit, I wonder how you're looking at new age tech, and if that at all is starting to, or just your view, just give us a sense of that first off.
You mean new edge technology oriented players? New
age technology companies, the Eternals, the Swiggys, the Paytms. I wonder how you're looking at some of those names, and how should one rationalize those names?
Yeah, in fact, that's what I classified as internet. So we do have exposure, and we're increasing exposure. So I think the framework that we have in mind is, at the one level, wherever there is feet on street involved in executing the value add to the customer, and internet is the platform for that. We don't see backward integration of LLMs down to a level where they'll disintermediate an Eternal, for instance, the example that you took. So to the extent that competitive dynamics is not a concern, capital cycles is not a concern, we are comfortable. We are very actually excited about these spaces. There are lots of polarizations in the classified space. So some classifieds are getting totally disrupted because the discovery is happening on an LLM itself rather than on the platform. And so, for instance, education as a classified. But having said that, there are other types of classifieds. Could be used car classifieds, used product classifieds, or even it could be jobs classifieds, where previously a large scale high volume problem was difficult to solve with a lot of human intervention, and the new age technology is helping provide solutions to that. So we're increasing exposure in that as well.
Okay. And Rakshit, I just wanted to get your sense on all the new paper that we're seeing coming into the market. We're once again in that phase where we're seeing an extreme IPO rush. Are you looking at the primary market at all? Anything that looks interesting?
Only after companies get listed and a couple of quarters have gone by, proof of the pudding around governance, around what was there in the account starts to emerge. We look at these types of listings. But yeah, I think in general, given how much of entrepreneurial activity the country has gone through in the last 5-6 years, secondly, given how much I would say new ways of executing business and generate cash have emerged post-COVID, post all the wars, and hence the way government spending has evolved. I mean, lots of companies which 5-7 years ago never used to make returns on capital employed above cost of capital have started to do so. So that's the supply side into this listing piece, and at the same time, I think the way financialization of savings is occurring, there's a demand side to this as well. So at many levels, it makes sense to see more and more number of companies get listed, widening of the market with good quality businesses coming up, and there will be demand. But not all such IPOs are good. I mean, history has lots of skeletons coming out from the cupboard, etc. And hence we try to take a more cautious view. Only and only if we've got a long history at the time of IPO available for us to understand, would we go and take exposures. Otherwise, we let conviction build on us gradually before we take exposures in new listings.
And Rakshit, you've obviously been tracking consumption for the longest time ever. But give us the sense, how are you seeing the cycle, and what pockets should you bet on, rural, urban, and what within consumption, even if I were to split consumption up?
Yeah, so certainly rural is doing much better than urban, and it's also interesting that initially there were concerns around rural's recovery could be short-lived because of the El Nino and the weak rainfall effect, etc. On that side, sowing the agricultural produce, etc., is not likely to be as bad as what was feared to be initially. Rainfall is better. So I think rural is certainly something which is, there are pockets of undervaluation or low expectations, positive surprise possibilities, which we are also increasing exposure to in our portfolio, and investors should do that. Urban, whilst it is holding up, I think market share gains and capital allocation is the way to grow earnings at north of, let's say, 15-17%. Otherwise, most categories of consumption, particularly FMCG, have approached a level where, I mean, mid-single digit volume growth is a very high one, which is not good enough in the long run for earnings growth rates to drive share prices above cost of capital in terms of returns. So it's a saturated industry, particularly the small ticket one. But the entire consumption piece is going through a massive price increases led revenue growth acceleration in the sort of short term. So after the crude spiked with the West Asia war and crude oil going to whatever 100 plus, price hikes were taken across FMCG, home building materials, and a variety of other consumption related industries. And that is leading to value versus volume gap widening to levels that we had not seen in the last 4-5 years. When you combine that with the possible operating leverage benefits that some of these companies could have, there is a short-term momentum. So, for instance, adhesives, paints, pipes, these are companies in the home building sector where value growth is 10-12% higher than volume, and that can certainly trickle down through operating leverage to earnings growth, getting a sort of acceleration in the near term at least. So those can be positive catalysts. I don't think they are very well baked into numbers in some cases, particularly for high quality players. And valuations have cooled off in the last couple of years in all of these areas. Share prices haven't moved. There's time correction that has happened. So valuation multiples are much more comfortable. So only in such pockets where you can see earnings growth through operating leverage, price hikes, and a very high quality capital allocation led, let's say, new category expansion that some companies are doing. If you've got earnings growth 20% or higher, we are taking exposures there, particularly where valuations are comfortable. But yeah, if you ask me for a 3 or 5 year view, FMCG is something which I would like to avoid unless the business is allocating capital to add new categories and hence grow far faster than the industry itself.
View on consumption and FMCG, and while you were talking about volume and value, Rakshit, how are you looking at auto, also part of the bigger consumption basket? We've heard one major player already come out with a price hike announcement, and come December or early next year, the price hike series will once again be at play. How would you then look at volume versus value when it comes to autos? And within autos, is there any basket that you're liking at this moment particularly?
Yeah, no, autos pricing power is a little lower than the home building material, paints, pipes, adhesives examples that I gave you. So in autos, you won't see that bigger delta, and at best they'll protect margins rather than see any expansion in margins because of the price hikes. We've got two types of exposure to auto in our portfolio. One is a two-wheeler premium player who is benefiting from a massive narrowing of the gap between premium two-wheelers and the sort of below 250cc motorcycles. And that narrowing of the gap is leading to recruitment from sort of mass market into premium segment, accelerating in a way which could actually sustain beyond just the short-term GST benefit of money in the pocket and things becoming a little cheaper like for like. So there could be actually premiumization gains here for the category as a whole. competitive intensity we see being pretty low in that area, and hence that's one space I would say in the OEMs we've got exposure to. And the second one is a tractor business, which is again a beneficiary of kind of a turnaround in business prospects, capital allocation, acceleration towards export orientation, and hence when you look at the valuation of that firm as well, there are some opportunities. So these are exceptions. Overall on auto, beyond these couple of names, we've either got a wait and watch or a sell recommendation internally.
Rakshit, thank you so much for joining us, giving us that perspective. We'll let you go.
Pleasure. Thank you.
Thank you. All right, we'll step on a very short break, come back, plenty to speak about. We'll have Kunal again come in, give us his views with regard to how he's looking at the current texture. We'll also have a panel of guests joining us, so stay with us.
Back with closing trades, and I was just taking a look at what's happening globally. While Europe is off to a tepid start, we're seeing flattish moves coming in all across, but DAX is lower by about 0.5%. Other than that, I'm just taking a look at what's happening with Brent, and there is now another 2.5% spike on that index. 93.7 to be precise is where we're at on the Brent. I just want to see some names where we were seeing some profit correction earlier. The likes of MRPL and Chennai Petro today, earlier in the day, were seeing some profit taking from the kind of surge that it saw yesterday. A 5 to 6% uptick on both of those names yesterday on account of supportive crude prices. If we could just have MRPL as well as Chennai Petro, and those charts should come up for you on your screen in about a minute. MRPL is lower by 1.6%, so the profit taking over there continues. And even for Chennai Petro, yes, the profit taking is slightly steeper. 3.5% is the kind of cut that we're seeing on Chennai Petro. ONGC and Interglobe Aviation are the next two stocks that I want to look at, because ONGC being an upstream company should benefit. It has recovered quite significantly from the day's low, and in fact is absolutely flat now on the back of the surge that we've seen in Brent. And lastly, Interglobe Aviation, key raw material in terms of fuel, and a 0.5% cut is what we've seen. A little exaggerated blip is what we're seeing on that stock right now. Kunal, your view on some of these oil or companies rather that use oil as a raw material. On one side, you've got the upstream players. On the other hand, there's paints, rubbers, Interglobe. How are you looking at all of these names? And for people, or our viewers rather, who are invested in these names, what should the next course of action be?
See, I think with the rise in Brent crude prices, there are going to be two things which could happen. One is that the oil sensitives, the ones which are pro in terms of when crude oil prices move up higher, ONGC, Oil India, etc., they would try to make a comeback for themselves. That's going to be very much likelier. But on the other hand, there is also going to be a possibility where the ones which have crude oil as a raw material, they are the ones which could see impact. For example, paint stocks, you see Interglobe Aviation, for example, and the stock today on such kind of a day is seeing a bit of a tepid price action. So we are bound to see that kind of a move which could trickle on to the next couple of days. So far in the last 3 days, 4 days of this week, since the time when crude oil prices had moved up from those $84, $85 to 90 plus, it was not showing too much of a material impact into either of the pockets, whether it's ONGC, Oil India, or whether it's the oil sensitives, Indigo, etc. But I think now with every dollar rise, for example, in the crude oil prices, say 95, 96 plus, the markets would be a little bit more cautious towards these kind of names. So I believe that oil sensitives at the current level could be more of a trade which could depend on how the crude oil prices move going forward. But the sensitivity now will start to increase with every dollar move for the Brent crude.
Okay, let me bring on board Arpit Beriwal as well to try and give us a sense as to how he's looking at the market. Arpit, great having you. Let me start off with the index itself. What do you make of the move?
Very good afternoon to all. This day we were waiting for quite a long time. So Nifty was forming low rise structure from past 12 sessions. And this is one of the rare scenario that we have seen that from in last couple of years that this structure has been forming. And today, finally, it is negated the formation of lower highs after almost 12 sessions. So looking from an index perspective, overall, the upside is capped. At the same time, downside also, Nifty is respected to 24,000 levels. So all in all, looking from a monthly expiry point of view, Nifty is likely to be in a range between 24,000 to 24,444. That is the immediate range. And once it closes about 24,444, then only there will be a clean momentum on the upside. But till that time, index is likely to be in a range with support at 24,000 on the downside, whereas on the upside, 24,444. Talking about Bank Nifty, so Bank Nifty was relatively a bit resilient comparatively. So Bank Nifty also today opened gap up, and since then it is consolidating. But the good part is that it is holding about 57,500 levels. So Bank Nifty is also stuck in a range between 57,000 on the downside, whereas on the upside 58,000. So all in all, indices likely to be in a range with slightly positive bias because you've seen a corrective move almost in last 8 to 10 sessions. However, stock specific and sector specific action is to be seen going forward for next coming week.
So, range-bound momentum expected with a hint of an upward bias. Arpit, hi, good afternoon. Also, give us your sense on which stocks or sectors are looking most attractive right now, because you did say it's time to be a little more stock-specific in a market like this. So, on that note, which stocks are looking good? Any recommendations for our viewers?
So definitely there are a couple of sectors. First would we stick with the heavyweight, that is the pharma space. So pharma sector has been a huge outperformer, and looking at the sector-wise pharma index, there was some slight consolidation. But if you look at the bigger term, it's still very positive. And I look at the chart structure of Divi's Lab. So Divi's Lab has been a huge outperformer, a classical monthly breakout or above 7,200 levels, and since then we have seen a strong momentum. Though the stock is consolidating, but looking at the sector-wise, the stock can definitely hit new life highs towards 9,000, 9,500 plus levels. So from the pharma space, Divis Lab would be a preferred pick. Second would be from the new age space. That is a lot of good momentum is seen in the new age sector, and that is pick would be Paytm. So Paytm also gave a classical monthly breakout above 1450, 1500 levels after almost 24 months, and since then some cool off was seen, but the bigger trend was positive, and the stock can easily head towards 1700, 1750 levels positionally. So Divis Lab and Paytm looks good for 6 to 8% upside move in the coming series.
TVs and Paytm looking good right now. Kunal, let's talk about some sectoral moves right now, because we're seeing a good move on realty, IT, FMCG. The only index that's in the red right now is defense, but that too just a cut of 0.2%. Within Nifty Realty, we're seeing some very good moves in the Brigade. We've seen positive news coming in for Brigade Enterprises today in terms of their collaboration with the Kerala Health Department, 4% uptick over there. Lodha up 2.5%. Signature Global doing fine. Anything that looks good from within the real estate basket?
Yeah, I think DRF is starting to look attractive at the current levels. 675, 680 is where the stock is trading right now. Looks attractive. My sense is that the stock should be able to break past about the 700 barrier this time around, hopefully by start of the next week. I think if that happens, this could probably give a fillip to the entire real estate sector, the Nifty Realty Index, which has been taking a resistance around this 850, 900 kind of a trading range. So we may see a comfortable break about those 900 plus mark for the Nifty Realty Index. The other stock to look out for is Prestige, a stock which had, I think, corrected almost 10% from a zone of around 1740 thereabouts to sub 1600 levels, where the stock is trading right now. So I think at current juncture, the risk reward seems to be attractive. Even for traders to take a bet on Prestige at the current levels. And if there's a mean reversion of sorts, we could be looking at a decent 5% to say a 7-8% swing upside for many of the realty names.
Okay. That's on real estate. And Arpit, two stocks in the market right now that are under some pressure despite the overall breadth being quite cheerful. That's REC and PFC. And the reason why these stocks are under pressure is because Morgan Stanley has downgraded PFC to an equal weight from overweight and also cut the target price. And similarly for REC, they've downgraded the stock to an equal weight from overweight and trimmed the target price to 360 now from 430 earlier. How are you looking at some of these power financiers, REC, PFC? Any targets on the charts?
If I see the monthly setup, so definitely the stocks are in pressure. And if in immediate basis, if we see the weekly setup, REC has been facing hurdle again and again from 360, 370 zones. And from last 2 weeks, the stock is from low rise, lower structure. So on the immediate basis, looking at the setup as on the monthly and the weekly setup, lower rise structure is likely to continue. And we can see some more pressure towards 310, 350 levels on REC. Along with that, if we see PFC also, as it's broadly, it's in under pressure. So monthly scale, almost a range breakdown, weekly scale of lower highs, lower lows. So looking at the setup wise, definitely there's no major reversal. And looking at the setup wise, definitely there could be some more pain before there's any major meaningful reversal. So PFC also can stock correct towards 350, 340 levels. So REC and PFC would be on the short side. And looking at the setup wise, there's no major reversal. On the upside, hurdle for PFC would be around 380, 82. And for REC, it would be around 340.
To watch out for on REC and PFC, and like Arpit was saying, the last 1 year also a cut of about 9 to 13% on all of those names, and those stocks have been subdued ever since then. But shifting focus then, I just want to take a look at some stocks that are at or very close to their 52-week high, and that's Welspun Corp, Lenskart, Sai Life, Leela Palaces, RBL Bank, Netweb, RR Kabel. You've got United Spirits. Good news for United Spirits earlier in the day that US FDA, the FDA, India FDA overhang is away from them now, so that looks good. OFSS is also just about 1% away from its 52-week high. Kunal, any of these names like a Lenskart, RBL Bank, Netweb looking good? And because these stocks are already very close to or at their 52-week high now, what's the further run-up looking like, if at all?
Yeah, I think what happens ideally in an ideal scenario is that when these stocks show signs of consistent week by week, month by month consecutive up move, that sets up the trend for many of these names. For example, I think you're talking about Welspun Corporation. The stock for the last, I think, 5 or 6 consecutive months has been showing signs of a very strong uptrend from a point when the stock was at 750, 800 just 5-6 months back towards the point when the stock is above the 2000 level. So the move has been quite spectacular for many of these names, and I would sense that on the back of the recent price uptrend for these stocks, the long-term trend starts to look attractive. The only catch over here is that many a times when traders get confidence in the market, they tend to buy these stocks which are at an extreme, and then once the market gets into a second leg of an uptrend, then there are sector rotations and stock rotations which happen, and the ones which are performed in the first leg, they take a bit of a back seat. So it's always better to try and aim for a price or a strategy where you can try and buy these stocks on corrections. So you need to keep some powder dry, or buy these stocks in a very staggered kind of a manner. That should be a strategy for many of these names. So they look attractive. The trend seems to be quite strong on the longer term basis, but buying the entire quantity at current levels may not be the right way to approach.
Okay, that's the take on some of these stocks that are doing well at their 52-week highs individually. But on that note, time to slip into a very short break. On the other side too, we'll be joined once again by Kunal and Arpit, and we'll take that conversation ahead. Stay tuned. Back with closing trades here on ET Now, and let's put the spotlight on one of the buzzers from the market today, and that's Z Entertainment. That stock is up almost 6% because the company's promoter warrant issue has entered a crucial phase, with 21st August being the deadline to deposit 25% of the 3,100 crore rupee preferential issue. The warrants could significantly alter Z's ownership structure, taking promoter stake from around 4% all the way up to 24% after conversion. Sunidhi is joining us with more details.
That's right. So Z Entertainment is in focus today as August 21 marks an important deadline for the company's 3,143 crore preferential issue through convertible warrants. The promoters have to deposit around 25% of the issue value, that is around 786 crores by today, with the remaining 75% to be paid over the next 18 months. The issue could be a major trigger for Z going ahead. Once the warrants are fully converted, promoter holding, like you said, is going to increase from 4% to 24%, while the company will receive all the 3,100 crores of fresh capital, which is big for the company. The issue was approved earlier by shareholders on July 31, with around 249 million warrants proposed at 126 rupees per warrant. However, there was a regulatory hurdle. SEBI had barred Z, Puneet Goenka and Subhash Chandra from accessing the securities market over the unauthorized pledge of Z's property. The key development, however, came on August 14 when SAT, the Securities Appellate Tribunal, allowed Zee to proceed with the preferential issue, and it also directed that the warrants be issued within 7 days, making the current deadline very important for the company.
Thank you so much for taking us through that. So yes, all eyes are going to be on how this development pans out. As of now, the stock is up 6%. Let's welcome on board Mr. Ajay Baga, who's a market expert, and get his understanding on how he's looking at the market, especially all of these stock-specific news and updates. Mr. Baga, hi, good afternoon. Thanks for your time. Before we talk about some stock-specific action, give us your sense on how you're looking at the markets, because after 7 days in the red, the market has finally turned around a little bit, and now today we're seeing some optimism. So far in the last couple of days, the FII buying has also once again returned, and we're all just hoping that it's here to stay, wondering if that's going to be a trend. How are you looking at the market right now, and do you believe that this turnaround today, although it's only been one trading session where we've seen green after 7 in the red, do you believe that this provides some amount of confidence to the market right now?
Tough to say.
Sure.
We have been flattish for 2 years, so a lot of the froth is out of the market. Valuations have caught up. We are not very highly valued or at a premium valuation to the rest of the emerging markets. That valuation premium has gone down. Earnings season this time around, the revenues outperformed while the profit margins did not catch up as strongly because input cost pressures were there. The Iran disruption also had an issue on the input costs. So overall, macros are doing well. There is a recovery in revenues. There is a smaller recovery in profit margins expected to go up in the later part of the year. But I think still we have some heavy lifting to do to really get foreign investors to come back strongly into this market and to see these markets rise again. So I think right now we are cautious. 1 day's move, really we'll have to wait and watch how this translates into. But macro good, earnings good, profit margins recovering, some amount of FI flows are returning. IT seems to be getting some inflows. Again, that is more some amount of sentiment turn rather than actually earnings showing up. I think earnings are still 2 quarters away before we can establish that. But markets move ahead of the fact. So that move has started in IT over the last 1 month. We have to wait and watch now on the financials starting to rally also. Then you will have 2 very strong drivers for the market. Industrials doing well, power doing well. Those have done their bit. But the risk remains a weak rupee, weak FI sentiment, oil prices, which will mean higher inflation, which create a specter of RBI raising rates early next year. So all those are the weaknesses. Lack of an AI pure play, so some amount of incremental flows going towards AI plays in Asia. And as a result of all this, our proportion in the MSCI EM index having fallen, that also means some passive flows have gone elsewhere.
Okay, lots of factors at play, Mr. Baga. Thanks for that view. And just like you were highlighting, for the last 2 years, we've been absolutely flat, and several marquee stocks across IT, banking, energy, healthcare, auto and consumer sectors have delivered little to no return over the stated holding periods, despite being major names in their respective industries. This list includes the likes of TCS, Infosys, HDFC Bank, Reliance, Maruti Suzuki, ITC and Asian Paints, some of the big heavyweights that have done little to nothing in the last 1 year. Avi is joining us with that list.
So buy and hold is the strategy that a lot of investors follow, and that is the reason we've compiled this list of stocks that have given 0 to almost no returns across different time frames, telling us that the buy and hold strategy may not always work in your favor, and timing and the pricing is always more important. So looking at some of the key stocks, we can see that big names like Coal India, ONGC, Indian Oil, ITC, HUL, TCS have given almost zero returns across different time frames, ranging from 6 years to around almost 15 years. So we can see several marquee names almost in the blue chip and mid-heavy segment of the stocks that we've seen that have given very less returns. Moving on to the IT segment, we've seen big names, and the commentary has been very strong that the attractive valuations is what is driving investors to come back and make a comeback in these IT stocks. We can see that big names like TCS, Infosys, Wipro, HCL Tech, Tech Mahindra have given zero returns when compared on a 5-year basis. So the time that COVID started, the prices were almost these, and that is the same price we are seeing as of now. Up next is the financial sector. Stocks like HDFC Bank, Kotak Bank are still at the price they were trading at around 5 years back. And that is the reason some private sector banks are being taken as a contrarian trade by a lot of fund managers. Big names like Bajaj Finserv, Jio Financial, Axis Bank, SBI Life have failed to perform and remain at the same price they were around 2 to 5 years back. Moving on to the energies and utility segment, we can see that the Coal India has given zero returns for almost 15.25 years. For some context, these prices are also linked to the commodity prices, as the commodity prices are cyclical, and thereby the timing that you enter in this stock is also very important. And that is the reason that someone who follows a strategy of buy and forget might see some zero returns in stocks like Coal India, ONGC for periods more than 10 years, which is very surprising. Moving on to the healthcare sector, a pharma story which everyone bets on, thinking that it will work in their favor as exports from India is a big thing for pharma. But stocks like Dr. Reddy's, Cipla, Max Health have given zero returns as they stay on the same price. Up next is the auto sector, with stocks like Tata Motors PV, even after delivering such strong volume growth of almost 50 to 60% on a YY basis. As we see in the monthly data, the stock is almost flat when compared on a 3-year basis, as it still trades at the same price. And such is the case with Maruti Suzuki and Bajaj Auto. Moving on to the consumer and retail segment, the story of consumption seems to be the play for Indian markets, but yet stocks, the big wiggies like ITC, HUL, Asian Paints, DMart, some investor favorites have given zero returns of 5 years, in the range of 5 years to 9.25 years. So a big range that we've seen, and marquee names, big blue chip companies that have given zero returns. So it is very important for investors to do their research and enter the stock at the right price and not blindly follow the strategy of buy and forget.
Get and forget may not be the best strategy always, especially when it comes to select large cap names like Avi was just highlighting. But on that note, time to slip into a very short break. We'll be right back with more on the other side. Stay tuned. Back with closing trades, and before the break, in fact, Avi, my colleague, was highlighting some stocks that have given absolutely no returns, little to no returns in the last couple of years, and some names that he was highlighting from the pharma pack. Dr. Reddy's was one of them. Kunal, a chart check on Dr. Reddy's. What are the kind of levels that you're looking like? Of course, today there is buzz in the pharma space on the back of the update coming in from Moderna that they have cleared yet another hurdle on their cancer vaccine journey, and yet another trial has come out to be absolutely successful. And on the back of that, at least Moderna as a stock globally has done well. We're seeing a little rub-off effect over here as well, but about a 1% uptick on Dr. Reddy's right now. What are some levels that you're watching out for the medium to long term?
Yeah, it's a decent move for Dr. Reddy, but it's not yet a signal of a big turnaround for the stock. It's just that in the last 2 months from the July highs, Dr. Reddy had been beaten down significantly from 1400 levels. The stock at one point had fallen down to 1100 mark. And it's now just stabilizing or trying to stabilize at the 1100 to 1200 zone. The stock is yet to confirm a breakout. At the breakout point, which I'd be watching out for in terms of Dr. Reddy, would be around the 1200 plus mark, 1205 to precise on the spot levels. Once the stock closes and crosses this level of 1205 is where we can expect that the stock can come back into a strong turnaround mode. Till that time, we may probably be a little bit more skeptical in terms of the bounce.
Okay, that's on Dr. Reddy's. In fact, we're getting some exclusive updates coming in from my colleague Prakash. The government is preparing a fresh policy push for the compressed biogas or CBG, city gas distribution or CGD sectors, with an incentive scheme aimed at boosting domestic manufacturing of critical equipment. Sources tell ET now that the oil ministry is working on a proposal to support the local production, and Prakash is joining us with more exclusive details on this. Prakash, what are you picking up?
Well, the government is planning to roll out an incentive scheme for the compressed biogas and CGD sectors. Sources indicate that the Oil Ministry is working on a scheme to support the domestic manufacturing of equipment used in CBG and CGD sectors. In fact, the process has been initiated. Sources suggest that the Oil Ministry has started discussion. In fact, the ministry is discussing the proposal with stakeholders. And equipments such as compressors, dispensers, skid and meters, trackers, gas detectors, gas purification systems, magnetic separators and feed mixers among others will be covered under the scheme. In fact, the incentive scheme is likely to reduce the overall input cost. In fact, the industry is highly dependent on imports to meet domestic requirement, but they are facing supply side challenges at this point in time due to global disruptions, and therefore the government is working on a comprehensive scheme to support CBG and CGD sectors. You are aware of the fact that the government is promoting compressed biogas production, and therefore a comprehensive scheme worth rupees 24,000 crore has been approved by the Union Cabinet. In fact, incentives being provided in a different form to enhance compressed biogas production, and the objective is to blend CBG into natural gas to reduce import dependence. A very significant development at this point in time. In fact, after taking various factors into account, the government is now planning a comprehensive financial incentive scheme to support the domestic manufacturing of equipment being used in CBG and CGD sectors. Back to you.
Okay, Prakash, thanks so much for taking us through all of those details. So yes, that's the exclusive coming in, and some stocks to watch out for are going to be MGL, IGL, Gujarat Gas. Arpit, a quick chart check on names like IGL as well as MGL. We were seeing moves on some of these names yesterday. MGL continues to be 1% higher. What's the outlook on the charts?
If I see both these stocks, so if we look at the weekly setup, the stock is trading in a range from last almost 4 to 5 weeks. MGL, if we talk about the range, is 1060 to 1200 is the upper band. And look in the image setup also, I think the stock is still likely to be in a range. Immediate basis 1160 is the hurdle zone for MGL. Till it holds below that, overall bias will be slightly in a range one move, 1160. Once it closes above 1160, we can see move towards 1200 plus levels. Now talking about IGL also, so IGL also has been in a sideways with negative bias, and also looking at the monthly setup, weekly setup, there's no major reversal, though it is not falling, but as of now there's no major reversal, trading below short-term moving averages. For IGL, the levels that we are watching out is 158. Once it closes above 158, then only we can see some stability on the upside, but till that time it will be slightly negative to range one move.
That's on MGL as well as IGL. Mr. Baga, I'm really interested in hearing your thoughts about all the back and forth that we're seeing once again between US and Iran, the kind of friction it's causing, and the up move on Brent. Brent is now very close to 94 once again. What is your outlook on Brent, and where do you think this negotiation, or rather the dialogue that US and Iran are trying to have with each other, is headed now?
Total stalemate. Trump wants an off-ramp. The Iranians are not providing an off-ramp. And unfortunately, what has happened is a lot of radical elements have taken over the levers of power in Iran. So we are seeing that there is no move towards a negotiated off-ramp from Iran. Trump has, as usual, been oscillating between saying that a deal is done or Iran is begging for a deal to now saying that no negotiations are on and we will economically strangle Iran. So the US stated policy has moved from hammering Iran into submission into strangling Iran economically and via the naval blockade, making sure that the Iranian economy suffers. It is not suffering because Russia and China are supplying it and picking up its oil. A lot of overland supplies are reaching Iran, including armaments. And so we are seeing that the Iranian missile production, drone production is really progressing very fast, and they are able to hold their own. So overall, in short, stalemate. Oil prices are showing us that the oil market is skeptical of an early resolution. The good news is that at least there is no active military engagement apart from the blockade from both sides. A few drone attacks on tankers on a daily basis, but no bombing, no infrastructure destruction, no mutual destruction. So overall, things not looking good. And for an Indian market, which is so import dependent on oil, it's not good news. Brent going here. We are expecting Brent to cross $100 by the weekend. And then let's see if normally some turn comes. Again, the outcome can be quite binary because we are just one handshake away from a resolution, in which case oil prices will fall very steeply. But right now, given the publicly stated positions, it's looking like both are very far apart. Iran definitely wants to do damage to the Republicans for the November midterms, which are on 3rd November in the US. So the Iranians want to string along this conflict at least till 3rd November so that maximum damage is done to Trump and his party. Trump wants an off-ramp, which he's not getting. So a large amount of frustration coming in the public discourse.
And that puts a lot into perspective in terms of everything that we're seeing on the geopolitical front. But once again, shifting focus back to our market and taking a look at some of the top buzzers today, it's Balrampur Chini that's up about 17% now. And what a move on some of these sugar names, given the kind of fundamental reasons that are at play. You're seeing some supply pressure coming in from Brazil as well as Thailand. You've seen more demand for sugar back home as ethanol blending goes on full speed. And you also have the festive season that's upcoming that is increasing the demand for sugar. And speaking of the move in sugar stocks, well, yesterday you had a bunch of sugar names that were doing well. Balrampur, Dhampur, Sri Renuka, EID Perry was flat, but you had Bajaj Hindustan Sugar that was doing really well. Today that move is sustained in Balrampur Chini. It's a 17.5% uptick coming in on that stock. The latest update that we're getting on the sugar sector is sources say that bulk consumers using more than 10 metric tons of sugar per month cannot hold stock beyond 15 days of their requirement. This is an order from the Ministry of Consumer Affairs, Food and Public Distribution, and this order will remain effective from 1st September to 30th November. Bulk consumers could mean confectioners, soft drink manufacturers, food processing industry consuming not less than 10 metric tons of sugar as average monthly consumption. So while this is a limiting order, take a look at Dhampur Sugar, for example, today 7.5%. EID Perry is picking up in trade 3.5%, but it's really Sri Renuka that is stealing the spotlight today, or rather Balrampur Chini, 17.5% now, 18% uptick coming in on the stock. Kunal, your view on some of these names and especially the kind of move we've seen in Balrampur Chini today?
Yeah, I think Balrampur Chini is something to watch out for. That's a stock which I think looks to be the strongest of the pack. We've seen Balrampur Chini, I think, inching up towards a fresh lifetime high. The earlier resistance for the stock was around 660. It's managed to cross that by a huge margin today and established a buffer at 765 levels. It's very difficult to initiate a buy at prices when the stock on a single day moves up by 17, 18, 20%. So I think it's better that viewers, I think, wait for some kind of a dip or a corrections into these names as an opportunity to buy. But then one of the other stocks in the sugar pack, which could also, I think, be something to watch out for and something which has not moved, is Praj Industries. The stock, I think, at 340-50 levels is also something to watch out for. It's been an underperformer of sorts. But then when you compare this with the 2024 highs, I think Praj Industries could be something which I think, even if it tries to inch back towards a 50% or cover up the underperformance of 50% with respect to the other peers, there should be an upside, a decent upside for the stock from the current levels.
Okay, that's on some of the sugar names, and that is a sector that we have been tracking. Other than that, just want to alert that Nifty metal has fallen from the day's highest point, is absolutely flat now, and in fact, it has edged over slightly to the red. Arpit, before we let you go, talk to us about your view on some of the stocks from the Nifty metal index. Right now, we are seeing the steepest cuts on a Hindalco, Lloyds Metals, as well as a Jindal Stainless. Anything looking good within this pack, or anything that you'd be cautious of when it comes to the metal index?
If you see overall metals after a sharp rally from last couple of weeks, it has been consolidating in a broader range. So if you look at the chart structure of JSW, Hindalco, Nalco, so broadly they're trading in a broader range. So looking from a perspective, from a monthly perspective, the stocks are still in uptrend. However, we have to be very much stock selective. And if we look at the structure of Nalco within the overall metal pack, so relatively the counter has seen a sharp upswing and at the same time downswing. But looking at the setup wise, Nalco still looks better. So the stock, the bigger trend is positive. It has been trading on the monthly time frame in a broader range. So the stock corrected from almost 420 to 380 levels. Now again, it's at a lower support zone. So I think Nalco can be bought near 375, 380 levels with major support around 360. And second would be JSW Steel. Overall, if you look at the structure of JSW Steel, it is in strong uptrend. Though it is consolidating, but at the same time, the base of the stock is shifting higher. So I think good base is formed near 1230, 1240 levels. JSW Steel looks good from the large cap, whereas from the mid cap, Nalco looks positive. So overall buy and dips setup in both the stocks with range bound to positive bias for coming few days.
Arpit, thank you so much. We'll let you go on that note. Thanks so much for coming in and giving us your views. All right, Kunal, no moves to the reference price at 315. We've seen a couple of minutes where there's absolutely no move on the index, or rather, very, very small move. Even the Nifty Next 50, the moves are very, very small.
I actually thought maybe it's my system issue at the start and the rates are not refreshing, but this looks to be a little bit strange that no trades as such are happening, or the range is very, very muted for the indices. We'll wait for maybe another 4-5 minutes till around 320, 325, and then probably get a better hang in terms of the volumes of the trade. Because I think over the last 2-3 days, we were looking at so for example, the end of the previous week, we had reached around 900, 950 crores as a volume. Till the last couple of days, the volume had jumped up to almost 1300 to 1400 crores approximately. So we need to see whether the markets maintain that kind of a volume, improve on that, or whether there is any kind of a deterioration.
Could this have anything to do with the sensex expiry at play? Any connection or?
Doesn't look like, Sneh, because in that scenario, in that case, ideally, the move on the sensex stocks should have been there.
More, right?
Yeah, it should have been ideally more.
That's interesting, the kind of moves that we're seeing coming in the cash segment. It's been 4 minutes now, and we've not seen any major moves in terms of volumes across indexes. Nifty flat, Nifty 100 is flat. We're not seeing any major moves coming in. I'm once again just taking a look at the Nifty 100 index, and it's Eternal that's looking really nice, along with the Hindustan Zinc, Lodha, LIC. In fact, today Eternal, Swiggy, Meesho. These are some stocks that have done really well. So the new age basket is looking good. Mr. Baga, your view on some of these new age tech stocks, and how are you looking at this internet as a theme, as a sector?
No, it's a theme for the decade, I would say. Again, most of the money was made by the PE funds. These stocks came into the public domain at very high price earnings ratios. The private equity, the VCs had already made most of the money. So that's how this cycle is different from earlier cycles. Earlier, what would happen is the riskier stocks, the narrative stocks, would get funded privately, and they would come quite early to the market. The private funds would like to get out. Now what is happening is the private funds are really bulking up these companies and bringing them onto the public markets at very high valuation. So that is what's been wrong with these companies, and we have seen post-listing the struggle that they've gone through. It's more an issue of at what point of valuation did they get listed. But overall, if you look at the theme, 1 out of the 4 billion people 1 out of every 4 people in the world that are on the internet are in India. We have massive penetration that's happening. Business models have been proved. The unit economies are still under discussion, under pivoting. But overall, if you see, they are really, they are addressing a very deep need in the market of speed, efficiency, and getting goods on demand. So quick commerce, I think, is here to stay. They will really grow in scale and size and somewhere profitability will start coming in, and the revenues will catch up to make the valuations more justifiable. That is coming. So long term, good holds, not too much allocation because there is so much more to the India story. Like autos, I like across the various segments in autos. I think that will stay an evergreen story. Private banks, again, a favored theme. Industrials, the government capex has created a very strong foundation. Again, private capex will catch up eventually, and you will see industrials continuing to do well. Anything to do with power, with energy security, should do well. So you are having a lot of choice in India. But these quick commerce companies, I think, are really a wave of the future. They are entrenched well funded, and they will generate good returns.
Okay, that's on some of the new age themes and the internet stocks. Just seeing some moves coming in as CAS is underway. You've seen a 3% cut coming in on M&M just in the last 6 or 7 odd minutes. Tata Consumers lower by 1.5%. HCL Tech now lower by 1%. You've got HUL2 that's lower by about 0.8%, and that's the kind of moves we're seeing on the negative side. However, on the flip side, within the Nifty 50 basket, it's JSW Steel that's up 1%. Similar uptick coming in for Apollo Hospitals as well as Hindalco. But Kunal, M&M and also let's put together Tata Consumer. 1.5% cut for Tata Consumer. M&M is lower by about a good 3%. Talk to us about how are the charts shaping up?
No, I think, in fact, yesterday also we had seen such kind of similar signals for few of those large cap names. This generally happens between 315 to 27, 28 thereabouts. But then the last, I think, couple of minutes, this gets settled into. So I don't see too much of a variation coming back into the stock prices on closing basis. I think the stock prices should try and settle towards the prices they were at the 315 kind of a mark.
I wonder, Ajay, what do you make of the entire CAS mechanism of market close, and any views, whether you have any over there?
No, but definitely I have a view. I think it was well thought out. Theoretically, it worked, but practically, we have seen the very fact that two firms were pulled up for market manipulation within 2 weeks. I think it shows that there are enough shortcomings in the system which can be manipulated. Good news is the regulator caught it. I don't think the entire profits have been caught, because these two companies will not trade so much in their name as far as the derivatives part goes. Those would have been sitting in group companies elsewhere. So I would say more profits have probably been made than what has been clawed back by the regulator. That needs to be seen, who all had positions that day and what profits were made, and if there is any linkage to these companies. One is a multinational bank-owned subsidiary. So, and we have to still see whether they were acting on the prop book or they were acting on client books. What was the client color? Was it an FI client coming in? Was it offsetting some other position elsewhere? I think all those will come in the subsequent SEBI investigations. Good thing is they've done a demonstration effect that you might think you're getting away with something like this, but we'll catch you. So regulatory wise, kudos to SEBI. System wise, I don't know, versus what was there. At least that was a tested system. Very fact that it could be manipulated so blatantly within the system. So we'll need a much quicker mechanism which then catches these companies faster. And there has to be an actual clawback of the losses that retailers might have faced. So again, I'm saying that 3 crores is hardly anything. The losses that day in the expiry were massive because of the very sharp move. So where did those profits go? And did anyone have some informed knowledge that this kind of manipulation will be done? I think that deeper investigation needs to be done.
And SEBI has in fact barred JP Morgan, the JP Morgan entity rather, Copthall Mauritius and Mansi Share and Stockbroking from securities markets, alleging manipulation of their sensex during the closing auction session, which Ajay was essentially alluding to. This is on the 13th of August is when these transactions have happened. SEBI's surveillance systems flagged 3 sharp sensex moves during the final 10 minutes, including 405-point move within 28 seconds. Anurag Shah here to address, in fact, the Mansi Share and Stockbroking firm. He's in fact outside Mansi Share and Stockbroking. Let's cut across listening to what he's making of things that are happening over there.
Capital market regulator SEBI has barred Mansi stock and share broking firm, and we are outside their branch office. The address mentioned, which is 340A Raghulila Center. Just a while back, the number also removed from here. The staff member inside this office has removed the number from outside this office, and they are also saying that Mansi stock broking office used to be here and now it's no more there. And as per their official website, the branch office address is this only, which is in public domain also. As per the SEBI order, the market manipulation was done on the cash side. A sell side order were placed in last minutes, and SEBI on 13th of August that order was placed, and later on SEBI found that, and SEBI has passed the order on the Mansi stock broking and barred entities from market. So we will also visit the registered office, but this is the branch office as per the public address. Just a while back, the poster of the address was removed from here. We have that video also. We'll show that video also. As of now, there is no mention outside the office, and the staff members are saying that the Mansi stock broking office used to be there and no more that office exists here.
Okay, thank you so much for that, Anurag. That's Anurag from Ground Zero, giving us a perspective of what's playing out. But very quickly, we're a minute away from 3:30 rather. Just quickly taking stock of where we're at, because then post that we'll just have 10 minutes of the cash session to close things off. Let's quickly look at the Nifty 500 index, some of the top gainers and losers. I want to first talk, there you go, that's sectors. Defense and chemicals is where some pressure was. But realty standing out, private sector banks doing well in trade, Kotak, HDFC and the like. You've got FMCG, IT and the Fin Nifty doing well. When you're looking at the Nifty 500 index, Himadri Speciality is the one big casualty of the day, 6.5% lower. Aster DM down 4.25%. Sirma down 4%. Chennai Petro, PFC, REC being some of the calamities of the day. 3% lower on both of those. Balrampur Chini is the one that stood out, 20% higher, 19.5% to be precise. Netweb up 7. MMTC, Brigade, Misho, Cohance, as well as HBL Engineering, all of them gaining 6% plus in the day of trade today. So some very good moves. Z Entertainment is up 6%. Whether the promoters land up putting those funds which they've received approval for or not is still a wait and watch. It's not yet happened, and tomorrow's the last day. So you'll have to wait and watch as to whether that actually translates. But the market clearly pricing in some gains on the back of that. 5% higher on MCX as well. That's the other one which has done well. Aditya Infotech is up 5, locked in upper circuit. Welspun, Canfin, Acme are just some of the other movers. Reddington also up 4%. But essentially today's move was led by the fact that while crude was at 92, the US 10-year bond yield has fallen, and so has the 30-year bond yield. You've seen a 10 basis point correction on the 30-year bond yield, 6 basis point correction on the 10-year bond yield, at least at the start of day today. And that has aided not just Indian markets, but global markets as well. Ajay, of course, continues to be with us, and Ajay, you always have a great perspective of what's playing out globally and on the macro front. What's the view here? I mean, the 10-year bond yield falling and falling quite precipitously. I mean, it's just 10 bips, but for the US 10-year bond, it's still quite precipitous in terms of the fall. Sustainable, you reckon? And our own markets as well as global markets, the kind of moves we've seen, largely fair. Is that how you would assess it?
Yeah, it was needed. Some kind of intervention was needed because the longer dated bonds from Germany to Japan to UK to the US were hitting multi-decadal high yields. So this kind of a demonstrative effect was needed from the US Treasury. So Scott Bessent has become one of the most interventionist US Secretary of Treasury in the last 50 years. And this is after the yen intervention, where the Fed intervened along with the Bank of Japan to shore up the yen in a coordinated manner. And they did some financial engineering to ensure that dollars and dollar assets were not sold out by the Bank of Japan. Rather, they sold euros, and they created a facility for Bank of Japan to keep on holding its dollar assets and borrow against that. Yesterday, what happened? The Fed opened an Operation Twist, Harsh, if you may. So just like the previous Operation Twist, what they are offering the market, come with your long-dated bonds, which you don't like to hold. That's why the yields are going up. I'll buy it at today's price, and I will issue shorter dated bonds. So you are afraid of the bond market being able to price the US debt, being able to support the very profligate spending of the US government. So I will give you shorter dated bonds so your risk reduces. Give me your long dated bonds. So this became an Operation Twist yesterday. The amounts are low. It's like $4 billion for every week, literally going up to November. So amounts are not very high, very significant, given it's a $40 trillion of US debt that is outstanding. But the demonstration effect that the Fed is cognizant, and there is a red line. There is a red line at 5.3% on 30-year US paper, which they will defend. They will not let the yield go further than that. So that became a big risk on for the markets, and we saw risk on sentiment returning in global markets, starting with the US markets and then Asia today. Along with this, Harsh, a lot of dominoes are stationed, which is the AI borrowing, which is the private credit borrowing. We have seen some runs on some funds in the past 1 month. But overall, a huge amount of leverage has been created in the system via the private credit market. So it's not the traditional bank lending that is happening, unlike 2008, but it's accredited investors, endowments, pensions who have gone into the private credit market and funded it. And the government of US very clearly out there defending that as well by defending its bond yield. So it was a morale booster for the markets. It brought down yields. As you mentioned, 10 years also came down by 6 basis points. 30 years came down by 9 basis points. How durable that impact? Again, a big linkage is to the oil price and the disruption by Iran, because that means inflation. And when inflation gets anchored, already inflation in the US for last 5 years has been above the Fed's target of 2%. So there will be a lot of pressure, but we don't expect any rate hikes either in September or in the October or December meetings this year by the Fed. Overall, the market is not pricing in a rate hike, but this was a huge sentiment booster, morale booster, as well as it showed the market that the Fed has a lot of armaments up its sleeve. It can come out with an Operation Twist kind of a bazooka if the market crosses a red line. That was the big demonstration yesterday, Harsh.
Okay, and this will, Ajay, just from a medium-term perspective, this basically is positive for equity markets, right? And how sustainable is it? Because the deficit for the Fed continues to balloon.
Yeah, the US deficit, if you see, has gone, the US debt levels are 40 trillion and the deficit is massive. It will probably be north of $2 trillion this year. Last month, July itself, it crossed about 400 billion. So clearly there is a problem with the US government spending much more than what it is earning. That has to be solved, but it can't be solved in a rush. The classic resolution for such high debt levels is to engineer inflation so that you're paying in, the value of money goes down over time. The second thing would be for the Fed to step in, like Volcker did in 1980 with the Volcker shock, where he raised overnight rates up to even 20% at one time. But that brings a huge recession into the global economy. So what central banks have done is, right from 2008 onwards, they have been kicking the can down the road and just going on building their balance sheets and letting these governments get away with such high fiscal deficits. So that comes home to roost sooner or later, but we are just postponing it for now. So I'm not expecting very tough measures from the Fed. Rather, it will ensure there is liquidity in their markets and in global markets. You can expect some dollar lines from the Fed to other central banks. They already provided it to the Bank of Japan because they don't want other banks to be selling US treasuries. That would be catastrophic for the US balance sheet. They would like them to keep owning that, and they would give them soft loans against that via a line. The third big thing that we are really expecting is some amount of currency move. So the Fed would like the dollar to weaken to make the second deficit, the current account deficit, the trade deficit that they are facing, and especially largely to China. And if you see, the yuan has been appreciating. So that is the US move behind the curtain, where they are wanting to engineer a softer dollar. So expect some moves on that as well. But main thing will be an orderly US bond market. They will ensure that stays, because that, if it starts rocking, it will rock the entire risk asset spectrum. Nothing gets spared then if that market becomes unstable.
Mr. Baga, thank you so much for putting all of that into perspective for us and our viewers, and thank you so much for your time today.
Thank you for having me.
Thank you so much. Shifting focus then, let's take a look at the FNO snapshot this hour, and we have Sarit who's joining us on the show with just that. Sarit.
Thanks, Sneh, for that. The Nifty ending 0.6% higher at about the 24,200 mark there. With the September futures seeing a lot of rollover happening there. So if you look at the open interest positions, we are sitting on some 50 lakh contracts there on the Nifty. So 82% jump in open interest today itself. So a hectic day of rollover. We're seeing some, short covering which came covering of positions that happened in August, and then fresh positions getting added to the September series there. Nifty Bank again ending just nearly 0.5% higher, and there too we saw a good amount of rollover happening to the September series with the open interest up nearly 45% in today's trade and premium of 477. Look at what's happening in the banking pack. Long positions getting added across all private sector banks, except for IndusInd, Bank of Baroda and Federal Bank. We've seen long positions across all the banks there, whether it's public sector or, for that matter, private sector banks there, especially in the month of September. In the call and put writing, you saw aggressive call unwinding happening at lowest end of the strikes, especially 24,000 and 24,100, while we've seen some build-up of open interest position at 24,200, and that's also giving the market good support at this point in time. If you look at the distribution chart, you'll get to see that 24,200 is now acting as a good support, with the backstop coming at 24,000 for the Nifty there. In the gainers part, in Nifty, FNO gainers, MCX saw short covering. The stock was up 5%. Mark saw some long. Muthoot Finance was active today. The stock was up 3.9%. In the losers pack, you had stocks like REC, where we saw a long unwind. PFC saw a long unwind, and BDL saw some long unwind. The stocks down nearly 2 to 2.5% in today's trade. Open interest gainers included stocks like Info Edge, where we saw short building coming up. ICICI Bank saw a long build up happening, and Axis Bank saw a long build up happening in today's trade. In the losers pack, you have Astral seeing a 34% unwind, which is happening, and that's basically unwinding of the current month's position, where again we saw Wari Energy seeing some unwind happening, and Ireda is also seeing some unwind happening just 2 days ahead of the monthly expiry. Most active today has been a couple of stocks. BSE has been BSE is one of the stocks where we saw some activity happening, especially in the options side there. But the Nifty ending finally at up nearly 0.6%, and strong set of open interest coming in, additions coming in for the September series.
Okay, thank you so much for that, Sajid. That's the FNO picture wrapped up for you and completely timed out on this edition of Closing Trades. From Snehi, myself, everyone who puts this show together, thanks so much for watching. More action on the other side. Stay tuned here to ET Now.